The past few years have reshaped how investors think about stability. Economic growth has slowed across much of the developed world. Inflation remains above central bank targets, and interest rates, though off their highs, are still elevated compared to the last decade. In this environment, investors are increasingly looking for practical, controllable ways to protect income and preserve long-term wealth. One strategy gaining quiet momentum lies in real estate investment, specifically the tax advantages of short-term rentals. Recent legislation known as the One Big Beautiful Bill Act made a key change that allows for short-term rental owners to fully deduct qualifying improvements immediately through 100% bonus depreciation. It's a strategy that combines real estate income, active business treatment, and accelerated tax benefits, all within a familiar investment class. In this video, I'll walk through how it works, who qualifies, and how property owners can best take advantage of this strategy. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Let's start with what makes short-term rentals distinct. When you rent a property long-term, say for 12 months or more, the IRS treats that as passive income. That means that even if you record operating losses, you can only use those losses to offset other passive income sources. But when a property is rented primarily for stays of shorter than 30 days, less than a month, the IRS may classify it differently. If you're materially involved in managing it, coordinating bookings, overseeing maintenance, or handling guest communication, the income from that property is considered active. And that's really important because your active losses can offset other income, including wages and business profits that you might have. In short, the same property that generates rental income can also serve as a powerful tax management tool, provided it's run like a business. Now let's look at where the real benefit comes from: bonus depreciation. Normally, the cost of property improvements has to be recovered over time through straight-line depreciation. For residential real estate, that's spread across over 27.5 years. So if you spend $100,000 improving your property, say upgrading your kitchen or something like that, replacing flooring or furnishing rooms, you'd only deduct a small portion of that each year for nearly 3 decades. Bonus depreciation changes that completely. Under Section 168K of the tax code, certain assets with a useful life of 20 years or less can be fully deducted in the year that they're placed in service. And under the One Big Beautiful Bill Act, the 100% bonus depreciation rule is now a permanent feature for qualifying improvements made after January 19th of 2025. That means that if you're purchasing qualifying assets, including appliances, furniture, interior upgrades, you can deduct the entire cost in the same year you install them, instead of waiting years to recover that expense. Used strategically, this allows property owners to plan upgrades during high income years, using those deductions to meaningfully reduce taxable income. Let's take a look at a quick example to make this a little clearer. Imagine a married couple who run a short-term rental that earns about $20,000 a year. They're planning $100,000 worth of upgrades, including new flooring and furniture. They also know that their income will be much higher this year in 2025 than next year in 2026. If they spread those expenses out evenly, i.e. $50K a year, they'd only be taking out partial deductions each year in depreciation. But if they consolidate the spending into 2025, they can deduct the full $100,000 right away. That move reduces their taxable income in their high earning year and saves them more than $25,000 in federal taxes. This kind of smart timing is at the heart of effective tax management. Now, to take advantage of this structure, the property has to qualify as an active trade or business. The IRS sets out several criteria to determine that, but here are the key ones to keep in mind. First, there's the 7-day rule. This means that the average guest stay at your property must be 7 days or less. Second, you need to show material participation. In other words, you're actively managing the property, including handling bookings, coordinating maintenance, and communicating directly with guests. Third, there's the 100-hour test. You must spend at least 100 hours a year working on the rental, and no one else can spend more time on it than you do. Fourth, the 500-hour test. If you dedicate 500 hours or more in a year, you automatically qualify as materially participating. Fifth, your historical experience can also count. If you've managed the property for 5 out of the last 10 years or provided qualifying services for at least 3 years, that can satisfy the requirement as well. And finally, there's the ongoing involvement test. If you're regularly and consistently participating for at least 100 hours each year, you could also qualify. The purpose of these rules is to confirm that you're operating a business, not a passive investment. So keeping documentation and consistency is absolutely key. The types of property assets that typically qualify for full expensing under Section 168K include furniture, appliances such as dishwashers, dryers, stoves, refrigerators, electronics, fixtures, and finishes, and qualified improvement property, which includes interior, non-structural improvements to existing buildings. To qualify, these assets must be used by your active short-term rental business and be placed in service, meaning installed and ready for guests during the tax year in which the deduction is taken. A key part of applying this strategy is effectively performing a cost segregation study. This breaks down your property into components, identifying which assets qualify for accelerated depreciation and which do not. It's a highly technical process, typically handled by a CPA or a specialist, but it can reveal significant opportunities that might otherwise go unnoticed. It's also important to note that the IRS has specific requirements for these studies, so professional verification is key for compliance and accuracy if you don't want to get into trouble. Ultimately, short-term rentals can be more than just an income stream. They can be a deliberate part of a broader tax and investment strategy. By actively managing property and using bonus depreciation strategically, owners can reduce taxable income in high-earning years, reinvest those savings into property improvements, and strengthen long-term financial flexibility. Success, though, depends on discipline, keeping thorough records, maintaining consistent involvement, and working closely with qualified professionals. At Pacific Wealth Management, we see this as a part of a larger principle. Sound financial management isn't about shortcuts. It's about understanding how each decision, whether it's real estate, taxes, or investments, can contribute to a more resilient financial future. Now let's close with a few key takeaways. 1. Short-term rentals may qualify as active income, allowing operating losses to offset other earnings or income that you might get from your job or another business. 2. 100% bonus depreciation permits immediate deduction of qualifying improvements placed in service after January 19th of this year, 2025. 3. Timing really matters. If you can align major improvements with higher income years, you can generate the maximum benefit. 4. A cost segregation study can help identify eligible assets and ensure compliance for the IRS. Overall, when used thoughtfully, these rules allow property owners to align real estate investment with broader tax and retirement planning to build income today while reinforcing financial stability tomorrow. Managed with foresight and care, they can play a valuable role in achieving lasting financial independence and security. Managed with foresight and care, they can play a valuable role in locking down financial independence and security. I'm Justin Kuntz, Managing Director at Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, be sure to visit us at www.pacwealth.com. Thanks.